Hello and welcome to this wonderful chapter, Dividend Policy. Today we are going to revise Dividend Policy chapter, a very easy chapter, a small chapter. So please focus on the lecture till the end of this video and your entire dividend decision chapter will be revised in about 45 minutes to 1 hour, and that will give you about 5 to 8 marks in the exam. Okay. So this dividend decision chapter talks about the role of dividend in influencing the share price. So there are two types of theories. Which are these two types of theories? One is called irrelevance theory. Dividend theories are divided into two types: irrelevance theory and relevance theory. What do you mean by irrelevance theory? It means dividend policy does not influence the value of the firm. Dividend policy does not influence the value of the firm, and relevance theory believes that dividend policy influences the value of the firm. Dividend policy influences the value of the firm. And second point you can note down here, firm can increase the value of share. Firm can increase the value of share by selecting optimum dividend policy. By selecting optimum dividend policy. So that is called relevance theory. So which is the theory which promotes irrelevance of dividend? Modigliani and Miller approach, or in short M&M approach. M&M approach believes that dividend policy does not influence the value of the firm. By changing the dividend policy, the value of the firm will not change. Value of the firm will remain same. So in order to increase the value of the firm, you have to increase the earnings, not changing the dividend payout ratio, because that will not help you in increasing the value of the firm. And under relevance theory, we have Walter model, Gordon model, bird in hand theory, bird in hand, which is also given by Gordon only. So Gordon revised model and traditional approach. Traditional approach. Who has given traditional approach? Graham and Dodd. D-O-D-D. They are very popular economists. Now they have died, but Graham has written a book also, The Intelligent Investor, which is very popular book. Benjamin Graham, yes, you're right. So now we will see their formula and their prescription. So what you have to understand here, formula and prescription as to what should be dividend policy of a firm. So please note down if you are writing little fast. Highly recommended that you must write it down, because one day before the exam, if you want to revise, it will be very useful to you. Okay. So can we go to the theories now? Yes. The first theory was M&M approach. So M&M approach belongs to dividend irrelevance theory. Dividend does not matter. So they have given you three formulae, and with the help of these three formulas they come to the conclusion that dividend policy does not matter. First formula is P0 equal to D1 plus P1 upon 1 plus K, which means the price of the share today is the present value of the next year's dividend and next year price. From this formula we can derive next year price will be equal to P0 into 1 plus K to minus dividend. So either of the two formulae can be used to find the missing figure. Second formula they have given you is number of new shares to be issued. Number of new shares to be issued, which we will call N1. Is it right? So N1 is equal to I stands for investment requirement, minus in bracket earnings minus N D1 divided by P1. Investment minus retained earning means fresh funds to be raised by issue of equity share divided by price of the share. So I stands for investment requirement, E stands for total earnings, N stands for number of existing shares at the beginning, and P1 already seen above, price at the end of the year. Four variables are there. So this is the formula for new number of shares to be issued, and the important formula is the third one, value of firm, which is written as NP0. So NP0 equal to N plus N1 into P1 minus in bracket I minus E upon 1 plus K. K means cost of equity. N1, P1, I and E I have already written in the second formula. So what is their suggestion? Suggestion is, first point, dividend policy does not matter. Dividend policy does not matter. That means by changing dividend policy, the value of the firm will come to the same. You can calculate. And second, we'll take one example after some time. And second, focus on earnings, not dividend. Focus on earning, not dividend. Okay. So this is my Modigliani-Miller approach. The second approach is called Walter approach. James Walter has given this theory. According to this, the price of the share is equal to D plus R by K into E minus D upon K. You can write K or K. What is D here? D here dividend per share, which can be 0 also. What is E here? Earning per share. In this formula, E stands for earnings per share. In the previous Modigliani-Miller, E stands for total earning. R is return on equity, return on investment, and K is the cost of equity or capitalization rate. Sometime in the problem they will say capitalization rate. Is it right? Why are you not saying yes? Yes. So four variables affect the price of the share today. This is called Volter approach. In the exam they can ask you find dividend. So you have to write the equation, find out the missing figure, whatever may be the missing figure. And what is the suggestion given by recommendation of Volter model? So recommendation of Volter model depends on what is the relationship between R and K. Okay. So if R is greater than K, then what is the type of firm? Growth firm. Then it is called growth firm. Growth firm. And what is the dividend payout suggested by Volter model? 0%. Don't pay dividend. Okay. Or if 0 is not possible, low payout should be given. If R is equal to K, it is called stable firm. Dividend payout will be anything between 0 to 100%. And if R is less than K, it is a declining firm. It is a declining firm. 100% payout. So if you follow this prescription given by Volter, the value of the share can be maximized. Is it right? So growth firm should pay 0% because the firm can use the funds better than the investor. R is equal to K does not matter, and R is less than K, firm is inefficient. It is better to transfer 100% of the earnings to the shareholder. Okay. Now next we will see Gordon model. So Gordon model also belongs to relevance theory. Dividend is relevant. According to Gordon model, the price of the share is E into 1 minus B upon KE minus B into R. Okay, what is E here? Earnings per share. In the exam, after writing the formula, you will write the meaning of the terms used. B stands for retention ratio. Retention ratio is equal to 100 minus dividend payout ratio. 100 minus dividend payout ratio. If dividend payout ratio is 80%, retention is 20%. Then what is KE, cost of equity, that you know. What is R in this equation? Return on investment. Return on investment. And what is B into R known as G, that is growth rate. B into R is growth rate. What is 1 minus B known as? Is dividend payout ratio. What is E into 1 minus B known as? Dividend. Dividend is equal to earning into dividend payout ratio. Is it right? This is called Gordon model. Then write down suggestions. Suggestions. Write down in one line, same as Volter model. I am not repeating again. Same as Volter model. If the firm can earn more than the cost of capital, better that the firm retains the entire earning, 0% payout. Now we'll come to 4, write down bird in hand theory. revised Gordon model, and it is same like Gordon model only. The price of the share is equal to last year dividend into 1 plus G stands for growth rate, upon KE minus G, or if next year dividend is given, D1 is given, next year expected dividend is given, then directly D1 upon KE minus G, subject to KE should be greater than G. If KE is less than G, then price will become negative. Then price will become negative. Do not write negative price. Do not write negative price in the answer. Write price is not determinable. Right? Price is not determinable. That is called bird in hand theory. Is it right? Gordon model and bird in hand theory are more or less same. Up to this you have noted. What is the suggestion? Right below suggestion. Same as Walter and Gordon model. Suggestion, write down. Same as Walter and Gordon model. Same as Walter and Gordon model. Same as Walter and Gordon model. Then the fifth one, write down. Traditional approach. Fifth one, write down traditional approach. In bracket given by Graham and Dodd. So price of the share is equal to M into bracket D plus E by 3. M is equal to multiplier, number of times the market price is of D plus E. D stands for dividend per share. In the exam, when you write the formula, below the formula you will write this. E is equal to earnings per share. In the exam, they can give you 3 variable and you have to find the fourth one. Okay. What is the suggestion of this theory? Maximum dividend. So this says you give maximum dividend. Dividend influences share price more than the earnings. Dividend influences share price more than the earnings. Because you see in the formula, dividend is given a weightage of 1 and earning is given a weightage of 1 by 3. Is it right? That is called traditional approach. Then you write down Lintner model. Lintner model does not give you the price of the share, but Lintner model helps you to calculate the dividend to be paid in the current year. So according to Lintner model, Current year dividend depends on last year dividend, current year EPS, and the adjustment factor, and the long-term target payout ratio. Is it right? So the formula is current year dividend is equal to previous year dividend plus in big bracket, inside the big bracket, small bracket, EPS into target payout minus D0 and then multiplied by AF. So what is D1 here? Current year's dividend. That is what the student has to calculate. How much dividend should be paid in current year as per Lintner model. It depends on how much dividend was paid in the last year. So D0 is last year's dividend. D0 is last year's dividend. EPS is earning per share. Or you can just ignore it. Target payout ratio means dividend payout ratio. Target payout is long-term dividend payout ratio. And AF means adjustment factor or speed of adjustment. This is used by the company to reduce the speed of dividend. They don't want to pay higher dividend in the current year if earnings have gone up, because it will create unnecessary expectation in the minds of the shareholder. Okay. Now write down dividend discount model. Under that write down A, zero growth model. That means dividend will remain constant, bracket constant dividend. In bracket write constant dividend. The formula is P0 equal to D upon K. Then second write down dividend growing at a constant rate. Dividend growing at a constant rate. So P0 equal to D1 upon K minus G, same as Gordon model, same as bird in hand theory. Don't worry, because most formula which uses dividend have the same formula. So write down nicely. Is it right? You can write nicely. It will help you before the exam. So can we go to the next discussion? Say yes. Why don't you say yes? So this is dividend discount model, zero growth model, growing at a constant rate, and C write down multi-stage growth model. Multi-stage growth model or variable rate growth model. So here more than one growth rate may be given. Is it right? So here calculate present value of all future dividend. Calculate present value of all future dividend. I will solve one question of each variety so that you will understand each model with the help of one example also. So continue to pay attention. And the last part of this chapter was stock split. Stock split means shares of higher face value are converted into shares of lower face value. So what is the benefit of stock split? Benefit is more number of shares are available for trading. More number of shares are available for trading. More small investors can participate in trading. More liquidity. More liquidity. Shares become affordable. Shares become affordable because the price gets reduced. Because this is a theory question in the exam. Benefit of stock split. Okay. Have you done? Say yes. Write down below some related formulae. Some related formulae. One related formula, write down dividend payout. If you are interested in writing, keep writing. Otherwise, enjoy the show. DPS upon EPS or total dividend upon total earnings. So you can be required to use this formula to find out the dividend payout ratio. From the dividend payout ratio, you can calculate retention ratio, 100 minus dividend payout ratio. Then write down return on investment. Related formula number 2. Keep writing. You will be required to use this in the current chapter. Is earning available to equity shareholder divided by net worth. Net worth, that is share capital plus reserve. Note, if reserves are not given, use share capital only. In some exam questions, they have not given reserve. Use share capital. Okay. Then another question is EPS. PAT minus preference dividend divided by number of, because EPS is required in many formulae. EPS will be required in Walter model, Gordon model, Graham and Dodd model, and they may not give you EPS. So PAT minus preference dividend divided by number of equity shares. PE ratio is market price upon earning per share. Is it right? Cost of equity, one formula is reciprocal of P ratio, which means P ratio is 1 upon K. One more formula. K is equal to one more formula, D1 upon P0 plus G. Depending upon the availability of data, if K is not given, but P ratio is given sometimes. Take reciprocal of P ratio, or if you can calculate using this formula, then you can compute the cost of equity using the second formula also. Is it right? Say yes. So now we are ready to launch some important questions of dividend decisions. Questions are printed in our class notes. If you have the class notes, you can understand better. The source of the question number 16 is study material and MTP of August 18. Are you ready? Question number 16. M Limited belongs to a risk class for which the capitalization rate is 10%. It has outstanding share and the current market price is rupees 100. It expects a net profit of rupees 2,50,000 for the year, and the board is considering a dividend of rupees 5 per share. M Limited requires to raise 5 lakh for an approved investment expenditure. Illustrate how approach affects the value of the M Limited if dividends are paid or not paid. So this is a revision of M approach when dividend is paid and when dividends are not paid. So we'll see the application of the theory in this example. Are you ready? Open the notebook, write along with me. Heading, write down calculation of value of the firm under M approach. Calculation of value of the firm under M approach. So M approach says the value of the firm will remain constant irrespective of the dividend payout. And they have given you 3 formula to prove their point. So we will find in the answer ultimately the 2 columns will give you the same answer. Whether dividend is paid or whether dividends are not paid. Please write down serial number. Particulars. When dividend is declared, when dividend is not declared. Keep around 2.5 inch blank in the column because some calculations are lengthy. If you can keep more space, you can write easily, nicely. Institute can also understand. And it will save time. You will not have to write the same formula 2 times. First, one by one we will solve. Point number A. First, what we should do, we should calculate the market price of the share at the end of the year using M approach. Because that will be required in the second step where you have to calculate the number of share to be issued. Ready? Okay, start. First, write down. Students are very active. Market price at the end of the year. P1 is equal to P0 into 1 plus K minus D1. Question should be in front of you. P1 is equal to, what is the current share price given in the problem? Can you see 100 rupees in the second line? And what is the cost of equity or capitalization rate? 10% in the first line, 0.10. When dividend is declared, then how much dividend they want to pay? 5 minus 5. Student will give me the answer. 105. Go to next column. P1 is equal to 100 into 1.10, but this time dividend is 0. So the answer would be 110. Simple mathematics. Okay. Now write down point B. Number of share to be issued at the end of the year N1. N1 is equal to I into bracket I into I minus E minus ND1 minus ND1 upon P1 upon P1. So how to solve this? I means how much investment do they require? So they require 5 lakh rupees. So N1 is equal to 5 lakh is your investment target. In bracket earning is 2 lakh 50,000. And out of 2 lakh 50,000, how much dividend will be paid? So number of outstanding share write down 50,000, 25,000 write down. Number of outstanding share 25,000. Here it has 25,000 shares. It's typing mistake in the book. It has 25,000 outstanding shares. Okay, make it 25,000. And dividend is how much? 5. So what you have written in the bracket is basically retained earning. Investment minus retained earning is fresh issue of equity share divided by 105. You can write in fraction also. 357 1.4285. Are you getting somewhere close to this? Very good. Next column. N1 is equal to 5 lakh minus 2 lakh 50,000, but dividend is not paid, so 0. Divide by price 110. Calculate. 2272.7272. 7272 shares, number of shares, which I will require now in the third answer. Now the learned student, intelligent students will write point C value of the firm. Practice in writing. Keep the notebook with you. Formula is N plus N1 in bracket into P1 minus in bracket I minus E upon 1 plus K. Write the formula. Written. Then how do you solve it? N is 25,000 share plus 3571.4285 into 105 minus in bracket 5 lakh minus earnings 2 lakh 50,000. Please solve. Divide by 1 plus 0.10. Final answer only. It's 25 lakh rupees. Is it 25 lakh? And what we have to prove that the answer will be same even if dividend is not declared. Not declared. So write down 25,000 plus 2272.7272 into 110 minus 5 lakh minus 2 lakh 50,000 divided by 1.10. So that is also rupees 25 lakh. That is also 25 lakh. So what is the note you will write here? What is the note? Value of the firm. Value of the firm remains same irrespective of dividend policy. So if you pay dividend of 5, then also 25 lakh. If you don't pay dividend, then also 25 lakh. So this is the typical question of Modigliani and Miller approach. So whatever they will ask in the exam, accordingly will frame the answer. They may only ask you first and second step, number of share to be issued. Then stop there. You can issue shares in fraction as per Modigliani and Miller approach, because it assumes that capital markets are perfect. Securities can be bought and sold in fractions also. So when you write in fraction, it becomes easier for you to prove your point that your value will remain the same. So that was question number 16 for you. Now we'll go to question number 12. So this will give you a practice of Walter model. Question is there in the study material and was asked in November 19 RTP. The following information pertains to Messrs. XY Limited. Earning of the company is 5 lakh. Dividend payout is 60%. Number of share outstanding is 1 lakh. Equity capitalization rate 12%, that is KE. Return on investment R is 15%. Compute the market value as per Walter model. Then optimum dividend payout ratio according to Walter model. So kindly answer, if your R is greater than K, what will be the optimum dividend payout ratio? Please reply. 0%. Firm is using the funds better than the investor. It is a growth firm. And then you have to recalculate the market price of the share at 0% payout ratio. Say yes. So we'll write down. First we'll make step 1. Calculation of EPS and DPS, earning per share and dividend per share. So first point A is total earnings. Anybody total earning? 5 lakh. Point B, number of shares. Anybody number of shares? 1 lakh is right. Point C, earning per share A divided by B. A divided by B rupees 5. And point D, dividend payout ratio. Dividend payout ratio 60%. Write everything, because institute will not give you marks if you write directly. I also know it is 3 rupees. 5 into 60%, 3. This is the height of presentation. Nobody will dare to deduct marks. Okay. So this is your earning and dividend, E and D of the Walter formula. Now write down step 2. The first question is, what is the market value per share as per Walter model? Market value per share as per the question, as per Walter model, in bracket based on current dividend policy, based on present dividend policy, what market price they will get. So the formula is price equal to, as per Walter model, D plus R by K into E minus D upon K. With lot of practice you will remember the formula. On the left side of the screen, dividend is 3 rupees. R is given 15%, 0.15. Cost of equity is given 12%, 0.12. Earning per share 5, dividend is 3, divide by 0.12. Good students will reply now. This is how you get good marks if you do lot of practice. Rupees 45.83, this is enough. Rupees 45.83. Answer is not over. Second question is, what is the optimum dividend payout ratio and what is the market value at that payout ratio? So for that I have to first write a note here. Note. Return on investment in bracket R, that is 15%, is greater than equity capitalization rate. So this will revise Walter model, that in bracket K, and that is 12%, correct? This way you write, don't leave anything. Such firms are known as, what they are known as, growth or declining? Growth firms. As per Walter model. Such firms are known as growth firm as per Walter model. The optimum dividend payout ratio for growth firms comma, to maximize the market value of the share is 0%. So this is the comment you have to write. 2 marks for this much also. And then write down price when payout is 0 is equal to, formula I have already written, so I can directly write now, because in same question there is no need to write formula twice. 0 plus 0.15 divided by 0.12 into bracket 5 minus 0 divided by 0.12. Final answer. So 52.08 is enough. Write down nicely. So what is our observation here? When a growth firm was paying 60% payout, its market value was 45.83. But when it revised its dividend policy to 0%, as per the suggestion given by Walter, the market prices increased. Note, the market value of share increases when payout ratio is 0%. The market value of the share increases when the payout ratio is 0%. So this is an example on Walter model. Have you noted down? Good student, will come to question number 18 now. One more question where we are going to practice Gordon and Walter model. Okay. With the help of following figures. Which figure? Mathematical figures, not human figures. Okay. Calculate the market value of a share of a company by using Walter formula, dividend growth model, Gordon's formula. So this will revise two formulae, and this question is an exam question also. May 2019 exam for 5 marks. So the data is dividend per share, earning per share, cost of equity, IRR and retention ratio. So when you are applying Walter model, use the formula of Walter, and when you are applying Gordon model, use Gordon formula. Is it right? Right. Directly we'll write the formula first because the data, they are easily available in the question. Internal rate of return on investment is called R and retention ratio is called B. Okay. First write down step 1. Market value of share. Market value of share using Walter model. Using Walter model. Exam question for 5 marks. It is a bonus mark. So here the answer is equal to, first time when you are solving, write the formula d plus r by k into bracket e minus d upon k. Then put the numbers given in the question. How much dividend is given? How much return on investment is given? 0.25. Cost of equity 0.20. Earning per share 10. Dividend divide by, yes, student will solve the question and now write the final answer. Rupees 55. Very easy. 2.5 marks. Then write down step 2. Market value of share using Gordon model. So here the price of the share is equal to E into 1 minus B K minus B into R. What is E here? E is 10. In your question, retention ratio was given in the last line of the table, 0.4. This is Gordon formula, dividend growth model. Now what is K here? 0.20. And what is retention ratio? 0.4. Return on investment is 0.25. So now you will get the price if you solve properly. Is it rupees 60? Question number 18 is over. Question was asked in study material November 2020 RTP, March 2019 MTP for 5 marks, and March 19 MTP also 5 marks, and finally in the exam May 19 for 5 marks. So this way we have practiced Gordon model also. Now we'll practice one multi-stage growth model. Is it right? So heading write down in your book, multi-stage growth model. More than one growth rate is given. A&R Limited is a large cap multinational company. Doesn't matter. Listed in BSE in India. Again doesn't matter. With a face value of rupees 100. This might be required. The company is expected to grow at the rate of 15% per annum for the next 4 years. Then 5% for an indefinite period. Okay. For year 0, 1, 2, 0.34, the growth rate will be 15%, and then the growth rate will fall, stabilize at 5% from 5th year onwards. Is it right? Till infinity it will remain 5%. So this is called two-stage growth model. First 4 years growth rate is very high. Now the question says the shareholders expect a 20% return on their investment. That is your discount rate. Company paid rupees 120 as dividend per share for 2021. This is the dividend paid in the last year. Paid word underline, already paid. But we have to take dividend that will be paid in future period. Okay. The share price of the company traded at an average price of rupees 3122 on the last day. So the price of the share given is 3122. You have to check whether it is undervalued or overvalued. We will do our calculation. Find the intrinsic value per share and also state whether shares are overpriced or underpriced. So what is the meaning of intrinsic value? It means present value of all future cash flow. Is it right? So write intrinsic value means present value of all future cash flows generated by the share. Next line, write down calculation of intrinsic value. We will prepare in a tabular format. Easy to understand. First column year. Second column, little bigger column, cash flow. Third column, present value factor at the rate 20%. Last column, present value. You can solve by equation format also. This is easier for understanding purpose. I hope you have drawn the format. Done. So first you write down here year 1, 2, 3, 4, 5 to infinity. It is also called terminal value. What it is called? Terminal value. That means value at the end of 4th year. Terminal value means value at the end of 4th, because first 4 year I will get the dividend. From 5th year onwards I will get dividend which will continue to grow at the rate of 5% forever. So what is the dividend you will write in year 1? Last year dividend paid was, come on, fill in the blanks. Last year dividend paid was 120. But first 4 year the growth rate in dividend is 15% per annum. First 4 years. So you will write here 120 into 1.15 to the power 1, or just into 1.15. So how much you are getting? In 2 digits. 138. Sure. Then your 138 will be into 1.15. That will grow at the rate of 15%. So learned student, please reply. 158.70. Okay. Then 158.70 will grow at the rate of 15% in the next year. 1 182.505. Sure. And then take 182.505 into 1.15. So this will be the dividend of the fourth year. 209.88. Now wait and stop. Wait, answer is not over. The main critical part is this one. Many students send me email also or ask the doubt on phone also. What is this last one which we have not understood? Is it right? So first you focus on understanding, then you can write any time you want. This is year 1, 2, 3, 4. Okay. But then what will happen after that first 4 year, which is a period of super normal growth, your dividend will stabilize from fifth year onwards. And from fifth year till the infinity, the growth rate will be how much? 5%? 5%. We have done the calculation up to 4 years. First 4 year we have written individual years. But from 5 I can't write 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. It will go forever. So I will have to apply the formula of dividend growth model. What is the formula? D1 upon K minus G. The formula D1 upon K minus G you will use when you have to calculate the price in year 0. But I have to calculate the price at this point. Because suppose I forget this 4 years are let's say over. 4 years are over. Forget 4 years. Now if I have to calculate the value after 4 years are over, the price of the share will be present value of the future cash flow from year 5 till infinity. Say yes. Which means the price at this point, let us call it P4, will be equal to D5 upon K minus G. Is it right? If P0 is equal to D1 upon K minus G, then price at the end of fourth year will be dividend of the fifth year upon K minus G. And what is the dividend of the fifth year? What is the dividend of the fifth year? So dividend of the fourth year is 209.88. But that will grow at what rate? 5%. That will grow at the rate of 5%. And that will be divided by 20%. K is the K 20%? Yes. Minus 5%. 0.15. So give me the final answer. 1469.401. 4016. One second. 1469.16. Okay. Wait. See, this is the difficult part. Very few students of intermediate are able to understand what they have done. Is it right? You are standing here. Suppose you are standing here. You are a human being with 2 ears, 2 legs, 2 hands. Okay. And now you want to know what will be the price at this point. The price at this point will be present value of future dividend, which is starting from year 5 and going till infinity. Say yes. So we'll apply the same formula which you apply for any growing dividend. Is it right? So I hope you have drawn this diagram. If not, draw it now. and with the numbers also. This you write working note 1, calculation of price at the end of fourth year. After 4 years, the share price will be how much? After 4 years, the price of the share will be present value of future dividend. At any point of time, the formula will be same. The price at this point is present value of future dividend. So at the year 4, the future dividend are dividend of 5th year, 6th year and infinity. And that is a growing perpetuity. That is growing at the rate of 5%. So I am going to apply the formula of a growing annuity, mathematical formula taught in your mathematics classes. Why are you staring at me with all anger? Done. See, I can't wait. Write fast. In the exam, you don't have to draw this, okay? You have to draw this much. So 1469.16 is the answer of P4. What is P4? P4 means price of the share at the end of the fourth year. P4. Now what I'll do with this number? I'll bring it to my main table. This is a working note, terminal value. In bracket write terminal value if you want to write. Whichever way you understand. But if you can't understand this 5 marks will be lost. So write here, how much was that figure? 1469.16. This is P4. This is not dividend. This is the price of the share at the end of the fourth year. Understood? Now take your calculator. 1 divided by 1.20 equal to 0.8333. Again equal to 0.6944. Again equal to 0.5787. Again equal to 0.4823. Wait, stop. What is the factor you will write for the, will you write for the 5th year or will you write for the 4th year? Quickly answer. Think and answer. God has given you a thinking chamber called brain. Then why are you shooting without think? Don't shoot. Think and shoot. This cash flow will be received when? After half an hour of explanation. When will you get that 1469? At which point of time? Purposefully I had written the heading at the end of fourth year. Purposefully I have drawn the diagram. Purposefully P4. So this cash flow will be received by us at the end of fourth year. Then why you said 5th year discounting factor? We will use fourth year because this is not dividend. This is price at the end of fourth year, which is the present value of dividend from 5th to infinity. Oh my God. 99% students in the exam are not able to solve this question. First of all, their teachers don't understand what is to be done. Okay. And if they don't understand themselves, they say leave it. Just 5 marks. How does it make a difference? The 5 marks can change your 6 months, your rank, your set off, your articleship in a big firm. Okay. Your career only. Now my job is over. What the learned student will do, you multiply these two, write in last column, use memory plus function also. Who will reply? First year. 1 in 2 digits only, let us not waste time. 95. Memory plus. in 2 digits. 110.20. Memory plus 105.62. Memory plus 101.22. Memory plus 708.51. 2 digits. 2 digits. We are writing price. We are not writing a atom bomb formula. So what is the total? 1140.57. This is the intrinsic value of the share. Intrinsic value means this is the price the investor is willing to pay, which will give him a 20% return. Is it right? If he buys the share at this price, he will earn a return of 20%. And what is the market price of the share? 3122. Oh my God, unbelievable. The market price of this share is 3122, but you are willing to pay only 1140.57. Is it overvalued or undervalued? Overvalued. Overvalued. So write a note or advice. The current market price is rupees 3122, which is higher than the intrinsic value of rupees 1140.57. Thus, it is overvalued by. Now take on your calculator difference between 3140 and 1140.57. Haji? 1971.43. Sure, na? Life of many people are at stake. I am getting a different answer. Just let me try again. Okay, ठीक है. So this is the 1971.43. Hence it should not be bought. 1981. 1981.43. Hence it should not be bought. Hence it should not be bought. Hence it should not be bought. Okay. This is called multi-stage growth model. They have asked in the exam also in the past. Write down, it is a past exam question. Past exam question. Many times they have asked, not just once or twice. Is it right? So we have completed the revision of all the important sums. Is it right? Hope you liked it. Thank you very much. Kindly revise again and again. All questions revise. This will make you stronger in this chapter. Okay. Mostly they will ask you Modigliani and Miller, Walter model, Gordon model, and this multi-stage growth model problem in the exam. Thank you very much.